let us summarize what you have learned today, right? In our last 4 sessions. So we started with learning fundamental aspects of entrepreneurial finance, together with life cycle stages of entrepreneurship ventures. We look into some special, critical factors that make an entrepreneur or entrepreneurship venture successful. All right, and we also look at different kind of financing needed at different life cycle stages of an entrepreneurship ventures in the first week. Okay, and next week, the second session, the following week, we look into generating and screening ideas, make it commercial, something profitable, something feasible. So that's the topic for something that can bring types and in you, right? As we say, the money capital should bring more money, and that's the reason we make investment. So if you're starting a new venture, you start with the ideas, but not all ideas are feasible. Not all. So that's what we're going to look at, right? Turn into profitable ventures. So we need to screen. So we have learned different kinds of methods to screen business ideas. And then so the learning objectives for this week is we are going to look into how we can actually financial capital costs. When you raise capital, organize using different financial sources available for a business. There are certain costs we call it as implicit, and certain costs we call it as explicit. We look into how we will also evaluate operating performance as well as some of the basic characteristics of new venture. So that's what we have done so far. Then we look into, we are going to look at the cost of capital, as we know, and when we look for different kind of the other aspects related to raise capital to run the business, rate of return, those finances given, and then we'll be looking at adjusted default liquidity and maturity given us component. There are certain costs associated analysis with every kind of the costs associated with every source of capital that we use to raise capital. And we're looking at also investment risks and so some historical relationship. We'll start with looking at different kind of cost of capital associated bonds and stocks, and we'll be looking at a process of estimating the cost of capital, calculating for public operations and private return, expected return and risk factors, and we end up the class with calculation of explaining weighted average calculate cost of capital, weighted average cost of capital, and also we will learn how to the question of weighted average cost of capital comes in when you have different sources. So when we start a new venture, if you are using only one source of finance, then just calculation of cost of capital, but the cost could be classified. But as the business grows, you may employ diversify even the sources of finances to run. So the formal historical accounting procedures, we will have many different kind of records of debt, and therefore interest and principal will need for us to calculate dividend capital. Weighted average. Those are explicit in nature. Okay. So I will start with usually these are the costs the concept included in the calculation. Teach you all cost of capital, conceptual aspect of but there is no provision. There is no provision of the implicit costs. For example, like then tangible expenses of basically learn how equity capital calculate, which is not really used in the calculation of cost of capital. Okay. Also, so we'll only use the explicit cost of capital. And we will make a conclusion of that, right? So that cost of capital will be compared with our expected rate of return for a project. Now, a financial market, before we go into detail, let us look at a bit of financial market. Financial market can be divided into two. One is public and the other one is the private, okay? So public financial market is basically it's a market for creation, sale, and trade of liquid securities having standardized features, meaning that it is a standard market, it is established market whereby we have standardized features, okay? Rules and regulations, procedures are being laid down, and you have to follow certain procedures before we can raise funds. So that is the public financial markets. And we do have also private financial market. We put it as a bookish definition, we call it a market for creation, sale and trade of illiquid securities having less standardized negotiated features. So privately arranged negotiations to raise fund for a business, okay? That's the difference, okay? So public financial market is a very standardized one. You have to follow the rules and regulation laid down by Security Exchange Commission of the country. But when it comes to private financial market, here it is less liberalized, okay, less standardized. So you can have negotiation with the the funding sources. You negotiate and then you raise fund. So cost of capital, all that depends on your negotiation skills and the agreement that you make with the funding sources, okay? Now, let us look at how we determine the cost of debt capital, the money that we borrow, okay, the money that we borrow. So there are many elements involved in calculation of cost of debt. We look at the interest expense or interest rate, and we feel that that is all right. So, which is not true. When you look at the debt instrument, it is not only the interest expense that a company pay. Rather, there are many other related costs that got to be taken into account. Okay, the first one is the interest rate. The price paid to the borrowers, right? The borrowing funds, right? To the lenders. So company is borrowing a fund, then the company is paying certain fixed amount of interest. That's what is called interest rate, right? And then we do have also default risks. A risk that the borrower will not pay the interest or principal on the loan, right? When you run a business, this is very common that some of the, if you are selling on credit, there'll be many defaults there, and even if somebody is lending the fund to the company, and the company, new ventures especially, get shut down, so you will not be able to pay the money that you have borrowed. Okay, so there is a default risk also there. Okay, so interest risk is there, you have to pay, right? There's a fix, but then the default risk is there, which sometimes been ignored by many individuals who doesn't understand finance and accounting. Okay, and then also we look at few other elements, for example, like nominal interest rate, which is the one that can be observed. Okay, the interest rate you pay, the interest that can be seen and observed, and stated interest rate, which is very clear. Okay, but the real interest rate, which is very important, real interest rate is the one that faced with the absence of inflation, risk, liquidity, and any other factor determining the appropriate rate of interest. Okay, so real interest rate is without inclusion of inflation, the risk factor, the liquidity factor, and other factors that may contribute to the appropriate interest rate for a business. Okay, risk-free interest rate. Okay, risk-free rate interest rate is basically the it's on debt that virtually free of default risks. For example, if you are buying a government bond, if you're buying a bond from government, government issued bonds. In US, they call it treasury bond, or UK even. So if a government is issuing bond and you are buying that bond, that's basically free of default risks, right? There's no risk associated with it. That's what we call risk-free rate. Okay, and then the inflation. That's what the whole world is going through now, and possibly in coming months we will be witnessing more of inflation. The rising prices. Okay, rising prices are not offset by the increasing of quality of goods or services, meaning that the quality of goods or services remain the same, but the price keep increasing. That's what we call inflation. So the product or services that we could get, say by 100 ringgit 3 months before, now it become 110, and possibly after 3 months become 120. It becomes, right? It becomes. That's what happened in Sri Lanka, in Pakistan, and many other countries now witnessing this after, during the post-COVID situation now. So when price increases without improvement of quality of services, that's what we call inflation. Inflation. So you have the money, but you won't have the ability to buy the similar kind of products that you bought it before. Okay. Now, so when we determine the cost of debt capital, the money that you borrow, these are the elements that we will consider to take them in the formula to calculate the cost of capital for debt. The first one is called inflation premium, IP. That IP will be using in the formula. So it is average expected inflation rate over half of a risk-free loan. Half of a risk-free loan. over the life of a risk-free loan. So if you are borrowing a loan for 10 years, and then we calculate the average expected inflation rate. That's what we call inflation premium, or IP. And the default risk premium is additional interest rate premium required to compensate the lender, the profitability that the borrower will default on their own. And so this is understood. So you are looking at interest rate over the default. Okay, so that's what we call default risk premium. Default risk premium, we'll use it as short form DRP. Then the third one would be the liquidity premium, charged when a debt instrument cannot be converted into cash quickly. As we know, businesses, when you operate, most of the sales are on credit. Or even a business buy raw materials, most of the raw materials we buy on credit. Okay, so when you buy on credit or sell on credit, so getting into cash may take a long time. I mean, even there could be some of the default there, so which have been taken into account earlier as default risk premium. But here we are looking at how faster can we convert cash, the receivables or payables into cash, right? So when you fail to convert debt instrument into cash, that's what you call liquidity premium. And then we do have also another elements with the cost. We call it maturity premium. It's a premium that reflects increased uncertainty associated with the long-term debt. When you borrow money, certain borrowings are short-term, which we may have to settle within a year. But when you borrow for long-term, say for 5 years or 10 years or 20 years loan, then actually you have more uncertainty. As the duration of payment or loan increases, the uncertainty also will increase. Okay, so that's what you're looking at, maturity premium. If shorter time you settle the loan, then it's better, right? The uncertainty will be lower. The longer term, the more the uncertainty. So maturity premium, that is MP also, that will be also taken in the formula. So this is how we calculate. A simple calculation, you closely follow me. I don't think you will have serious problem understanding this, okay? So the risk-free rate of return, RF, would be the real rate of interest, right? And inflation premium, okay? So, and that by effectively default-free for borrowers, okay? So as I said earlier, I have given example to you that a government-issued bond. So buying a government-issued bond, virtually it is risk-free. Okay, that's what you are calling at RF. Okay, RF. And RD is the expected return on debt. Expected return on debt. So we are going to calculate. So the formula would be record rate of return, right? Then your inflation premium, then your default risk premium, then liquidity premium, and maturity premium. We add on all these, real rate of interest, inflation premium, default risk premium, liquidity premium, and maturity premium. When we add this all, it becomes the expected rate on expected cost of capital. Expected cost of capital for debt. Okay, RD. So RR plus RP is RA. Earlier I have shown it. So we can think of, we can make it simpler, that RD, that is the cost of capital for debt, equals risk-free rate of return, default risk premium, liquidity premium plus maturity premium. Okay, so that's how the formula looks like. Okay, there's this one. I'm not going to do calculation on the whiteboard. Rather, I'll show you a simple calculation example here. Okay, so this is an example. Say, for example, you are given real interest rate as 3%, inflation expectation is about 3%, default risk is 5%, liquidity premium 3%, and maturity premium 3%. So we add on all this, and this all together, it becomes the cost of capital for debt. Okay, cost of capital for debt. So it is not necessarily only interest rate. There is the normal perception of ordinary people who doesn't understand accounting or finance. Okay, so they will only look at the interest rate. But as an accounting finance student, we have to understand that the cost of capital for debt, when you borrow, is not only the interest rate. Rather, we do have few other elements, including inflation, default risk, liquidity premium, as well as maturity premium. That's all added together, and it become the cost of capital for debt. Okay. Any questions so far? Anyone? Oh, since no one is responding, I guess no one has any question. Okay. All right. Let's look at the next one. What is investment risk? When you are making an investment, investing money into a business, of course, you always have a chances of losing or gaining. Okay. So when we invest in a business, before we do the investment, we have to do certain calculation of expected rate of return and the risks, as said earlier at the beginning, right? And the kind of data available, historical data available of similar kind of ventures when it started before, we take into account about those, and then we put them into a tabulated format to see whether the risks can be offsetted by the higher amount of profits that you earn. Okay, so in that case, we'll be looking at different scenarios of economy. When economy is in recession, when economy is stable, and when economy is booming. So if your expectation of economy is booming, your profit expectation is different. When you are expecting economy to be stable, then your expectation is different compared to when economy is in recession, right? As at this current moment, the whole world economy is in recession, and you can see easily see that in the increasing of the price of the necessary goods that we buy every day. Inflation rate is getting high. Okay, so in this situation, definitely our expectation of profit will be different compared to when economy is booming or economy is stable. Okay, so debt equity or founding investors like business angels or venture capitalists, they'll all calculate the investment risks before they really invest the money to you, right? So when we start business, as owner of the business, as somebody initiating new ideas and converting into something commercial business and all that, we will be also calculating expected, kind of risks and the expected return. And we'll see at the end whether I'm going to gain surplus cash flows over the risks and costs that is associated with the business. Similarly, people or institutions who are going to invest in your business, they'll be also making a calculation on your project before they give you the money. Okay. So investment risks is a widely accepted measure of risks. We use the standard deviation basically, okay, for possible investment returns. So we will look at different probabilities of business and different expected return based on different kind of economic situation. Taking into account of that, we'll be calculating the investment risks, okay, investment risks. And the measure of investment risk is dispersion. So we'll be using standard deviation to calculate that, okay. This is a simpler way of doing it, okay. Possible return, calculating your possible return. So suppose you're buying a stock that costs you $100 and you get a dividend of $10, you're expecting, and so your ending stock value would be 110, right? $100 you bought and then you receive 10 and then the stock ending value is 110. So formula for rate of return is cash flow, the cash flow that you get in, right? So that is the dividend that you get in. And the ending value minus the beginning value, the other beginning value. So that gives you the calculation for expected rate of return, okay? So and that's how we calculate it, okay? So these are the data available, right? When you're buying a stock and say last year, and it costs you $10, $100, and then at the end of 1 year, they pay you $10 dividend. And looking at the stock market prices, you see that the price will go up like 110 at the end of the year. Then how we calculate the expected return from your investment, right? So now you are looking at somebody who is investing in your ventures, in your business. Okay, so this is how we calculate the possible return. Now let's just look at this scenario. Okay, you have three different economic situations here: the rapid growth, normal, and recession. Okay, say for example, the rapid growth, the probability is 30%. And if it is a rapid growth, your probability of getting return is 60%. Okay, and if the economy is normal and you expect the rate of return 20%, and when economy is recession, right? Economy is recession, then say for example, your probability is 30% that economy is going to be in recession. So the expected return could be minus 20%. Okay. So from there, we calculate the expected rate of return. Okay. So let me get into the whiteboard and show you how we calculate it. Okay. Possibly, let me go through one more slide. Then after that, I will do a calculation. Okay. This is how we calculate the whole one. But again, like that, I'm going to do it in the whiteboard so that everyone can understand me. Okay, so let me stop presenting and get into the whiteboard. Okay, give me a second. Just give me a few seconds. Okay. I'm going to create a hypothetical question for you, and I want you to follow me doing the calculation. Okay. Can you see the whiteboard, everyone?
Yes, sir.
Can, okay. Thank you. So, if you cannot see, you have to tell me, please. So, say for example, we look at data. Then we look at the right? Of no, happening that is state of economy, and we look at expected rate of return. Okay. So I'm giving a hypothetical example. Let's see whether you understand. Say, for example, economy is in a rapid growth. The probability is only 20%. And if that happens, your expected return is, say, for example, 50%. And if economy is in a normal situation, the probability of having economy normal, say, for example, 40%, and your expected return if it's normal, say, for example, 30%, and if economy is in a recession, say your probability would be another 40, right? So that makes it 100%. So your expected return could be minus 10%, say for example, 10%. So this is the data that we have gathered. This data is not given, right? This data for businessmen, for you as a student, it's given for calculation purpose. But for us as a owner of a business, or as a person who would like to initiate a new venture, we have to use certain forecasting techniques available to come out with this percentage, okay, with the data available. So first thing that we have to do is to calculate the expected return from this project, because we do not know which one is going to happen. It may be in the recession, the economy could be in the normal situation, it could be in the rapid growth. So we take into account of all that, okay, because the business is not something short term, it's something long term that we think of, right? When you start a business, we think that the business is going to continue forever, okay? So in order to calculate the expected return of this project, what you have to do is you multiply this, okay? I make it a shorter way, okay? I use this place so that I can calculate the whole in one attempt, okay? So in this case, how much do you get? 0.2 multiply 0.5. So I think it's going to be 0.10, okay? But still, I want to confirm it. Let me do the calculation, okay? So it's 0.10, it's fine, huh? It's right. And 0.1212, sorry. And this one is going to be minus 0.04. Okay. So if it is a rapid growth, so that is what you expect, the expected rate of return. Huh? The probability multiply the expected rate of return. If economy is a normal situation, so that's what you expect. If economy in a recession, then those you expect, okay? Now, if we add these three together, so it's going to be how much? 1 plus 1.
0.18, sir.
Okay, 0.18. Thank you. 0.18. So the expected return from this project, say for example, we are talking about project A. So our expected return is 18%. Are you following me? Anybody has a question?
No questions, sir. Very clear.
Very clear, right? Quite simple calculation. Thank you. So this is how we calculate the expected rate of return. And then now from this, we will proceed to the next stage of calculation, whereby we are going to calculate the expected risks from this project, expected risks from this project. So in that case, we will be using the standard deviation calculation, but we have to calculate this question first. Okay, so the formula would be 1, I use probability 1 as P1, in expected rate of return, so I use as R1 minus I put as R bar. R bar is the expected rate of return of the project. Here we have already calculated, we'll be using that. Is square plus probability of 2 into R2 minus R bar square plus probability 3 into R3 minus R bar square. That is the formula that we use to calculate the risks associated with the projects, okay? So in this case, our probability 1 is 20%, so 0.20. R1 is, probably, yeah, R1 is 0.50, 0.50 minus R bar is 18%, we have just calculated, 18 square, right? Plus probability 2 is 0.40, R2 is 30%, so 0.34 minus R bar square, plus probability 3 is 0.44, minus 10 minus 10, sorry, minus 18 square. Okay. So if we calculate, we are going to get how much? Here is going to be 32 square, right? 0.32 square plus 0.40. Here you have 0.12 square plus, sorry, this is not 30, yeah, 40. 0, and here you have minus 0.28 square. Are you following me?
Yes, sir. Yes, sir.
Yes, sir. Yes, sir.
Okay, thank you. Thank you. So how much we get? We square it. I didn't have a calculator, so I'm using my phone.
20480.
Sorry?
20480.
20480. This is the total calculation or what?
No, only for one.
That cannot be right. 0.20 multiply 32 square, 0.32 square, 0.32 multiply 0.32. Okay. And then equals multiply 0.2. Okay, I got it. 2.048. Am I right?
Yes, sir. Yes.
All right. Thank you. So here would be 0.12 multiply 0.12. So this what you get multiply 0.4. 0.12 multiply 0.12. It's 0.00578. Is it correct? 0.32 multiply 0.32 equals multiply 0.2. This one is not this. This one is 0.02048. Okay. And then this one would be 0.28 multiply. So you get 0.03136. All right. Can you still see my whiteboard? Right? Yeah, you can see the whiteboard. Okay. Now we add on this. So we have basically here
0.057662.
62. Thank you. So that's what you get from the variance calculation, right? This is what we call
Is
variance.
that 0.05762?
Yeah, it's 0. Definitely is 0. Thank you. So this is our variance, right? This is variance. So from here we have to now root over, then we get standard deviation, right? So is I write it here, but variance is 0.05762. So the standard deviation would be root over 2.05762. How much do you get? If anybody can tell me. You root over and tell me, please. One. What do you get? Do you get this? 24?
0.2400.
Yeah. 0.0041663. Okay. So I just write 0.24. Is that okay?
2 decimal places, sir.
Because after that all 0, right? No point of taking more. So our standard deviation is 0.24, right? So that's what we have calculated. What does it mean? Is this business very risky? Can somebody just infer your thinking? What do you think? Is this business risky? Risky? Your expected return that you can expect is how much? 18%, right? Standard deviation is 24. Standard deviation, if it is close to 1, is the most riskier one, huh? Close to 1. If it is close to 1. So it is far from what? 1, right? So in that case, individual project, we may say that may not be that risky, because here also, if you look at the data, rapid growth is 20%, normal is 40%, meaning 60% probability is there that the business is, the economy going to be good. So 60% is on the good side, and that's why it's not that risky, looks to be, right? But when you have different projects, remember, we have many different ideas, then we'd like to make it commercial. So we'll compare one project another against another, or we'll compare a few projects together. In that case, this number would be compared with another project's number, and this rate of return would be compared with another project rate of return. Okay, this is how we calculate the risk factor and expected rate of return for a project. Say, for example, this is your expected return from this project, 18%, and then after that, later we will calculate the cost of capital. Say, for example, cost of capital you have calculated is 15%. So if cost of capital is 15% and your project is 18%, so your markup is only 3%. So your cash flow going to be only 3%. So now we have to think and decide whether you want to embark on a project which gives you only 3% cash inflow. Are you following me?
Yes, sir. Yes, yes.
All right. So say, for example, if the cost of capital is 10%, the money that you have borrowed, then in this case, your surplus cash will be 8%, which looks more promising compared to the earlier 3%, right? That's the reason we calculate this, okay? So we calculate expected rate of return. We calculate also the expected risks that we may face. And also, we calculate the cost of capital. So we compare the three before deciding whether a project should be undertaken or not to be undertaken. Is that clear? Clear, right? Quite simple calculation. I'm very sure you are very familiar with this kind of calculation. It's not that difficult. Okay. All right. So if you've no question, I would like to continue. Okay, can I?
You may, sir. You may.
Thank you. All right. So let me share the screen again. Then I'll go back to calculation again. All right. We do have to do some more calculation. Okay. This is an example given how the calculation was done. Okay. I have done it for you, and then you have seen me how we did it, right? So I don't think you will have any difficulty. So this one, once I share the slide in the e-learning portal after the class, you can download this and you can practice this, okay, to make you proficient in doing calculation on this. All right, let me proceed. So that's how we put it in a slope, right? Put it in a slope and see how it can be easily transparent for us to understand, right, on the risk and return relationship. All right, now the other one is definitely the earlier we look at the cost of debt, and this one would be looking at estimating the cost of equity. Businesses, when you start, you may start a business by, if it's sole proprietorship, the capital comes from your own. If it is partnership, the capital comes from the partners, right? And if it's a corporation, then money could be raised. Fund could be raised from many different sources, including the bond, stocks, depending on the which life cycle you are in, right? As we understand from the first week session. So if you are borrowing fund, you need huge amount of fund. Possibly you might be going for issuing stock, or the other option would be issuing bonds. Okay, and these two actually premise gives you opportunity of raising billions of dollars to run a business. Okay, so estimating the cost of equity here, we look at private equity investors, whereby you are looking at proprietorship, partnership, and owners of closely held corporation, right? And also we look at some other opportunities whereby you have publicly traded investors, right? So once you get listed with the stock market through following the Security Exchange Commission's rules and regulations, then definitely is going to be listed in the stock exchange, and it become public, right? So when we look at the calculation for the estimating cost of capital for stock or equity, we look at the organized security exchange, the physical locations, right? In Malaysia, we call it Bursa Malaysia. Before we call it Kuala Lumpur Stock Exchange, right? It's become Bursa Malaysia now. And also we can buy and sell shares in over the counters, which is available now, the electronic market. Even before COVID started, those modes were available, okay? And also we add on with the market capitalization, okay? The multiplier of price by the number of shares outstanding. Share outstanding meaning that when a company would like to issue shares and raise fund, they may apply at the same time to the Security Exchange Commission that we'd like to raise, say for example, 10 million ringgit. But then when they started the business and look at, analyze the situation, they feel that they do not really need 10 million ringgit now. So they raise 5 million. The other 5, they feel like, okay, we keep it approved, but later we will sell the shares and raise the fund. So those 5 million ringgit that's not being raised, but already approved, those called outstanding shares, okay? So that is also taken into account in the calculation of cost of equity, okay, cost of stocks. This is the formula that we use, okay? Similar, right? Earlier, when it comes to debt, we look at default risks and maturity, right? Because every loan that we have, every borrowing or lending will have a maturity period there, 1 year, 2 years, 3 years, based on the number of years that is agreed upon. Okay. So here we'll be looking, the formula would be like RE, the expected cost of capital for stock or equity, equals RA plus IRP, right? IRP is equity investment premium, risk premium. And then your RR is, we know, real rate of interest. And then we look at inflation premium and equity investment risk premium, okay? So these are the few elements being added, okay? But later we make it even simplified, okay? When it comes to capital asset pricing model, that's it's known as is, right? So the cost of capital for equity would be risk-free rate plus market rate of return minus the risk-free rate of return multiply beta. That's how we calculate the cost of capital for debt, okay? Let me go to the whiteboard again, rather showing you the slide, and stop sharing. And use the whiteboard to do the calculation. I think it would be easier for you to understand rather than we look at the slide, okay? So let me go to the whiteboard again and do the calculation for you to understand. All right, so we say the cost of capital for equity equals, I put capital, it doesn't matter whether we put small or capital, it doesn't matter. And RM minus RF in beta. So this RE is basically cost of capital for equity, okay? Cost of equity, I just put in short, cost of equity. This is risk-free rate of return. Earlier I mentioned it, right? It's a government issued bond. We compare that interest rate, okay? So this is risk-free rate of return. Risk-free rate of return.
Oh, sir.
Yes.
Excuse me, I can't see the next after our word because it the light reflect the whiteboard, so I can't see clearly.
Okay. 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 Thank you. Can you see now if I switch off the light?
Okay, now can, sir.
Can you see now?
Yes, can, sir.
It's better, so
Okay. Okay. All right. Okay. So you can see the whiteboard, right? As you said.
Yes, sir, can.
Okay. Okay. Thank you. Thank you. RM is the market rate of return. Market rate of return. RF, we know risk-free rate of return, and beta is the risk factor. Okay? So that's how the formula works. Now, I'll do 2-3 different calculations to see how it works. Okay, so please closely follow me and understand. And definitely, when I give you the slide, there are a few calculations also there, so you can practice. And later, I will share a few questions also with you so that you can practice at home. Okay. So, say for example, you have raised capital by issuing shares, as we call equity, right? Because when shares as sold, shareholders become the owners of the organization. That's why we call it equity, right? They have the equity in the business. So, say for example, RF is 5%, market rate of return is say 10%, okay, and beta is 2. So now we have to calculate the cost of capital for equity. In that case, RF is, if you put in a formula, so 5% plus RM is 10%, RF is 5% multiply 2, right? So you have 5% here plus 5% multiply 2, okay? So you have 5% here multiply 10% here, 15%. Is that understood? It's a very simple one. I'm starting with a very simple one. Is that clear now?
Clear, sir.
Clear, right? Okay. Now, so I erase this. If you have copied it already, I'm going to erase it now. Okay. Now, say for example, cost of capital RE is, say for example, given 15%. Okay. And then RF equals 7% is given. And then your beta equals, say for example, 1. And now you are asked to calculate RM. Can you please do it now and tell me how much answer do you get? And after that, I will do it on the whiteboard. Tell me how much do you get? RM equals how much? Anyone?
Is that 23%, sir?
Oh. Can you do one more time? Can you try one more time? Let's do together. Okay. So what we have here is 15%. RF is 7%. plus RM we have to calculate minus 7% multiply 1% equals 7% plus RM
15%, sir.
15%. Thank you. So this one goes off. So RM equals 15%. So depending on the kind of data given, then you have to do calculation. Okay. So this could be one situation. So we may also give you, say, for example, RE, RF, RM, but we don't give you the beta. Then you have to calculate the beta. That is the risk factor, right? Beta. Okay. Now, let me show you another one. Sometime, say, for example, I have given you data of RF, say, for example, 7%. Equals 1.5, and we give you market risk premium. Market risk premium. Market risk premium, say for example, I have given you say 8%. So now we have to calculate RE. Can you?
So are we using the same formula?
Yes, same formula.
Okay.
I did not give you market risk of premium, rather I've given you market risk premium. There is the difference. Market risk premium means RM minus RF. Now it's easy. Okay. So your RE equals RF is how much? 7%. 7% plus 8% multiply 1.5, because RM minus RF, this is what we call market risk premium. It is given as 8%. So in this case, it's going to be how much? 7% plus %. So 19%. Is it clear now? Anyone has a question?
So if the question state that the one was the market risk premium, so we just have to calculate directly, lah, sir?
Yes, meaning that RM minus RF is given. So you calculate directly, just put that value there. It's become even easier for you. Okay. So sometime if a lecturer wants to make it tricky, we give you RM, we give you RF, then we put additional question, calculate market risk premium. In that case, this just have to calculate RM minus RF before do the further calculations. Okay. Any question?
So, how do we identify which of the value is the RM, RF, or the RA?
It is given. Usually, it is given. Usually, it's given. For you as a student, this data will be given. In a question, you will get all this data there. You have to just find it out, and if you extract it and put it in the formula. But in a real business, it's different. In real business, we have to have many kind of data available. Then we calculate what is the market rate of return, the calculating the risk factor and all that. So some other data needed to be collected. But as a student, for you to do calculation, this data are basically given. Either you are given RF, RM, and beta, or you are given RF and market risk premium. In that case, you'll be using this formula. Okay. All right, huh?
So can you give us one more example of previous question?
Previous question, calculating the RM, right?
Yeah.
Say, for example, in a case you are given the RE equals 15%, you are given RF equals 8%, and you are given a beta, say for example 2, make it easier for you. Now we want you to calculate what is the market rate of return. That's what it is, okay? So now, looking at the formula, what do you have? RE equals 15%, RF is 8%, plus RM is none, we do not know anything. It's not given, and we calculate. This is 8% multiply 2. We take this 2, right? So now 15% equals 8% plus, if you multiply, it becomes 2 RM, right? 2 multiply RM. So 2 RM minus 8% multiply 2 is 16%. Okay. So if I keep RM in one side and bring all the percentages in one side, or maybe let me make it easier not to. So 8 and 16, 8 minus 16, so you are going to have here 2 RM minus 8%, am I right? So if I bring this 8% this side, it becomes positive. So 2 RM equals 15% plus 8%. So RM equals 23% divided by 2. So it's going to be 11.5%. Is that clear?
Yes, sir.
So it all depends on what kind of data is given to you. Then we extract those data and then put it in the formula. And then normal calculation, you just follow normal, the one you have learned in your
Clear now, sir. It's clear now.
Sorry?
It's clear now. Thank you.
So I proceed, okay? So let me go back to the slide again. Share screen. So that's what we did, huh? That's what we did, huh? So you can see here MRP, market risk premium. RM minus RF is the market risk premium. That's what we are looking at earlier, right? We have just done the calculation. So this one I will not do, similar to what you have done before. So I don't think I'm going to do it. Let's move into the calculation of WSCC. Okay, in the chat box, I see what question you have. Oh, okay, you have just given your answers. Okay, okay, no problem. So let us now look at the weighted average cost of capital calculation. First of all, let us understand what is weighted average cost of capital. When you run a business, you may not be raising fund from one source alone. That may not be even feasible for you. When business grows bigger, and then you raise fund from multiple sources of finance. Okay, and then you have different cost of capital for different sources of finance. See, if it happens that you raise the same amount of fund from different sources of finance, then you do not need to calculate weighted average. You just calculate the average cost of capital. It's enough. Okay, but if you are raising different amount from different sources of finance, then you would need to calculate weighted average cost of capital. Okay, so again, I wouldn't prefer to share the slide. Rather, I go to the whiteboard. Would be easier for you to understand me. Okay, so let me go to the whiteboard back. Huh? All right. Let me make it easier so that everybody understands me and you understand the class. Okay. Say for example, so we are talking about weighted average cost of capital, weighted average cost of capital. That's what we are going to look at now. So say for example, you have raised 5 million by issuing shares. That's what we call equity. Say for example, you have raised another 5 million by issuing bond, that is debt. Okay. And the cost of capital, RE, for equity is, say for example, 12%. And cost of debt, that is RD, that's what you have learned earlier, say for example, 15%. So in this case, the amount that you have drawn here is similar as the amount you have drawn from the debt. In this case, we do not have to calculate weighted average cost of capital because the weight is the same, 5 million, 5 million. In this case, you have to just calculate average cost of capital is enough. So you have 12% plus 15% divided by 2. Okay, so it's 27%, 27 by 2, so it's 13.5%. If we have this kind of situation, then the question of calculating weighted average capital doesn't come in. So the weighted average cost of capital calculation, this question only comes when you raise different amount of amount by different sources. Say for example, you raise 10 million by issuing shares, is equity, and you raise 5 million by issuing debt instrument, say for example bonds. Business will prefer mostly issuing equity, over the debt, because debt you have obligation to pay interest every year. But if you're issuing equity, raise fund by issuing equity, then you don't have obligations. Of course, investors have expectation on you to pay them back certain amount of money, right? So that's a dividend. So of course you have a pressure of performing well. But in case the economy is bad and somehow it didn't do well, then if you decide not to pay the dividend, it's still okay. But in case you are raised fund by issuing debt, there's no option. You have to pay the interest rate at the end of the year. So you have obligation to that. Okay. So now, say for example, you have raised 10 million by equity, 5 million by debt. And here the cost of capital for equity, say for example, 10%. And cost of debt is, say for example, 12%. In this case, we cannot calculate the average. Why? Because the amount is different. The weight is different. When the weight is different, that's where the question of weighted average cost of capital comes in. Okay. So if you look at that, what percentage is issued by raised by offering equity, and what percentage raised by issuing debt? You have to calculate that multiplied by cost of capital. Okay. So WACC, I make a simplified way of doing it for you. Okay. So what we do, we put it as E divided by E plus D. Then I will get a percentage raised by equity. Okay. Multiply the cost of capital for equity. The amount we raised by issuing debt instrument or bond divided by the total amount we raised. We want to get the percentage raised by issuing debt. Okay, multiply cost of capital for debt. Okay, I'm simplifying it. So now here I have raised 10 million and here I have 10 plus 5. Multiply 0.10, and here I have raised 5 million divided by 10 plus 5, right? Multiply 0.12. That's what I have, okay? So 10%, 10 million divided by 15. 10 divided by 15. So we have 0.66. See, for example, we just add on, we mark up, multiply 10. And here you have 15, so it's going to be 0.33, right? 0.30, 0.33, say 4, multiply 0.12. So 0.10.
0.067.
Okay, 0.067. And here would be 0.03. We use 3 lah. We know, otherwise it's going to be, oh, it's all right, it doesn't matter. So how much do you get then? 0.067, right? 0.067. Yes.
The 0.33 times by 12 is equal to 3.96. So,
How much?
3.96, I think.
396.
And, no, sir. 3.96.
0.33 multiply 0.12. 0.396. This is point, this is point, and this is.
Oh, okay, sir. Sorry.
No problem. So plus, so it's a 1 and then plus 0.067. So it's basically 10.66%. If you add on, you will get 0.1066, which is 10.66%. I'm slowly moving. This is not the final calculation. We have something more. We'll look at that. We have to take into account of the corporation tax, but I'm going slowly. Anyone has question on this calculation? Anyone? No, okay. Please be mindful. Sometimes we may not give you the amount, we give you percentage. What percentage we reach by issuing shares? 66.7%. We may give you this amount, meaning you don't have to do this one, it's already given here. Okay, percentage is already given. So 5 million is not given, rather we give you percentage, the percentage of amount raised by issuing debt. So that one is here. So this one you don't have to calculate. You are already given the percentage raised, okay? So the simplified formula is WSCC equals percentage of capital raised by equity multiply RE, okay? And percentage of debt, percentage of capital raised by issuing debt multiply RD. That's what it is, okay? So if the percentage is given, you straight go here, and you straight go here. If percentage is not given, rather given the amount, in that case, you have to calculate the percentage. Then you have to follow this formula. Okay. Anyone has a question?
No questions, sir. Clear.
All right. Thank you. Thank you. Okay. What will happen? What is the actual case is, beside this data, if you are given, if you are given the corporation tax, say for example, corporation tax in Malaysia is like about 30%. If this data is given, then where do we incorporate this data? Is the tax applicable to equity in a company, or the tax applicable to the debt in the company? Which one? Come on, come on.
Don't know, sir.
I don't know. Okay, let us look at profit and loss account. Then you will understand. Huh? Let me go back to the basic and show you. Profit and loss account is what? Sales minus cost of goods sold. You got profit minus all expenses. You get profit before interest and taxes minus interest payment. Okay, then we get profit before taxes, then minus taxes. Then you get what? The net profit. And from net profit only you pay certain amount of dividend. If you pay dividend here, then the next amount would be the retained earnings. That's how the profit and loss account looks like. Okay, so you can see the interest payment is done right before taxes, right? Right. Then only after paying the tax it becomes net profit. Okay, so the tax has to be deducted. Tax has to be deducted from the loan that you have paid because you have already paid it, you see, and that's why the loan would be appropriate here, would be applicable here in the formula. I'll make it shorter here so that I can add on there. Okay, so debt divided by E plus D multiply the cost of capital for debt multiply 1 minus corporation tax. We have to extend the formula there. Following me? So we will now do calculation again. So now we have additional data. So here is 10 divided by 10 plus 5 multiply RE is 0.10. Here you have 5 million over 10 plus 5 multiply, we have 0.12, and then we have 1 minus 0.30. 1 minus corporation tax. We have to incorporate that in the formula. Okay. So now here we have 0.7 multiply 0.10. We have calculated earlier. And here we have 0.34, say for example, multiply 0.12, then multiply again 0.70. Okay, so now here is 0.067, and here I forgot how much you get last time. 0.34 multiply 12. 0.34 multiply 0.12. Okay, so 0.0408, and then multiply 0.70. That's what we have to do additional here. Okay, so 0.067 plus multiply 0.7. So 0.02856. Okay, plus 0.067. So it becomes 0.09556. Okay, so it is 9.56%. Okay, so in case, this is actual case because every country got corporation tax, and we have to take into account of the corporation tax in the calculation. Okay, but sometime in the class or in the exam, we may not give you the corporation tax percentage. In that case, you don't have to use this. Okay, but most of the time, we give you the real case. In that case, the corporation tax is given. If it is given, then you have to use this way. All right? Any question before I move on? Anyone? No, huh? Since nobody asked, so I assume everyone is very clear. Okay. Let me give you another scenario. It's an hypothetical, the hypothetical calculation. I'm just giving examples from my own thinking, okay? So it may not be translated in the real case in the industry. Say, for example, you have raised equity, you have raised 10 million by equity, raise 5 million by issuing debt. And say, for example, you have raised equity here is common stock. Say, for example, preferred stock, you use 5 million. So you have now 3. No more 2, 3. So the cost of capital for equity common stock is, say, for example, 10%, debt is 13%, and preferred stock is 8%. And then we also give you the corporation tax, 30%. And now we want you to calculate the weighted average cost of capital. Okay. So how do you do it now? You can write with extended one. So let me show you. So in this case, WACC, weighted average cost of capital, would be E divided by E plus D plus P, right? I'm getting the percentage. Multiply 0.10 plus D divided by E plus D plus P multiply 0.13 plus, and then here we have to incorporate corporation tax, right? 1 minus corporation tax, incorporate, and then you have P divided by E plus D plus P multiply 0.08. Do you follow me? Because we have now 3, okay? So in this case, we have 10 million over 10, 5, 5, 20 million. Multiply 0.10 plus 5 over 20 million multiply 0.13 minus 1 minus 0.30 plus 5 over 20 multiply 0.08 is there, right? So you have here is 0.5 multiply 0.10. Here you have 0.25 multiply 0.13, 0.70, and here you have 0.25 multiply 0.08. Okay. So in this case is 0.05 plus, let me do it the calculation. Multiply 0.13, 5.7. So you get 0.02275, and here you get 0.25 multiply 0.08. So you get 0.02. Okay. So plus 0.02275 plus 0.05.
Sorry?
Okay, 0.09275. Just a minute. I'm coming back to you. 75%. Yes, brother, please. Yes, that one asking question, please. Raise it now. Asking question. Sorry, I was busy with the.
I have question.
Yes, please.
Why only D we need to time with the corporation tax, sir?
Because earlier I have shown you in the profit and loss account, we pay interest before taxes. Okay. So you have already paid the interest payment before taxes. Then if you are again charging the taxation there, then it is double charging. So you have to take out that amount. Okay, that's why, because when you have after tax is profit before, after interest payment, it become profit before taxes. Then after that you pay the taxes. Okay. Then only after that you pay, it become net profit, then you distribute the dividend. Okay, so interest payment is before, it is done before tax payment. It's already paid to the dividend holders. Okay, that's why we have to multiply 1 minus corporation tax for debt only, not for the stocks, not for the equity. Okay, I know.
Yes, I understand. Thank you, sir.
Okay. Any other question, anyone? No? All right. So that's what was in the syllabus for today. We understood. I tried to summarize the topics that have been covered so far from week 1, session 1 to session 4. And then we started a new session for today. We look into cost of capital, different kind of cost of capital. And we see how can we calculate cost of capital for equity or shares, and how can we calculate cost of capital for debt. And then when a corporation, when a venture uses more than one sources and different amount being raised for the business, then we have to use WACC calculation. That one also I have covered quite extensively for you to understand the different situations, how can you calculate that, okay? So I think this would be our last class before Raya. I've already given you assignment 1 and assignment 2. This is week 5. So your submission is week 7. So now I'll look at the calendar and fix, give you the date, exact date. I'll do that after the class. Exact date of submission, okay? And I will also assign the group projects. Hopefully, if I can do it today, I'll do it today. Otherwise, I'll do it tomorrow. That one you have to, you start thinking, how are you going to do it, okay? So I'm going to assign a group project. You have to basically watch a video available in my YouTube channel, and then I will also share the slides. Based on that, you have to do a group projects. I will tell you exactly the instructions, what you're supposed to do. Okay, and for this chapter, if you would like to practice a few questions, I think I will share in the WhatsApp group after this class. A few questions on how to calculate risks and return, those elements that we have done using the different economic states, right? Whereby you calculate different probability and all that. So I'll give you 1 or 2 questions on that. And also I give you a few questions on calculating expected rate of return using CAPM, CAPM, capital asset pricing models, which we will look at into the RE equals RF plus RM minus RF into beta, right? The formula that you look at. I'll also give you a few questions so that you can practice and make you proficient, okay? And prepare you for the final assessment that you're going to have later, okay? So now, the word of the day, the attendance sheet is available in the e-learning portal. I don't have to share, it's there, you know where it is. So, word of the day would be cost of capital. Cost of capital, that's the word of the day. Please fill in the attendance sheet. Please fill in the attendance online available. The word of the day is cost of capital. All right, before I close the class for today, I would like to wish Selamat Hari Raya to all of you, those of you who are celebrating. And wishing those of you who are not celebrating Raya, wishing you will have a good race and good holidays ahead, okay? So I see you after Raya, after the break. I will have, actually, I will conduct another 2 classes. I'm supposed to complete 7 sessions with you, and that Dr. Hussein Asli will take it over, and then he will have a rest of the 7 weeks taught by him, okay? So last times for you, in case if you have any question from today's sessions or even earlier 4 sessions, and if you have any question, you can raise it now before we end up the class today. Anyone? Raise hand, yes. Yes,
So
Ranjini. Yes, yes.
so I have the question about the assignment.
Mhm.
That's the assignment 2 that we are required to do an analysis of the annual report for the listed company. So is it necessary that we have to analysis the annual report by taking the latest year, or we can take the previous year, like 2019 or 2018?
2019-20 should be just fine. Even 18 is okay, no problem, because the purpose basically to teach you how you do the analysis. So even if you use 2018, I'm okay with that, no problem.
So what if and that's another thing that the ratio, are we necessary to use the ratio analysis in analysis?
Yes. All those
financial-
measures we being taught, all methods got to be employed.
So all of the method, or we have to pick like
Yes.
3 to 5
Yes.
methods is fine. lah.
Except the comparative analysis. You don't have to compare with the industry. You don't have to.
So just internal ratio analysis
Yes.
for its company.
Yes.
Okay, thank you, sir.
Welcome.
Sir,
Yes.
may I know the format of the assignment?
I have mentioned that I do not want to give exact format for you. I would like to leave it to your creativity and innovativeness in presenting. Because in the first assignment, I have mentioned already what you're supposed to do. You have to go to my IPO, and then definitely if you are choosing, say, for example, patenting, then you have to define what is patenting and why it is used. And then you have to look into the procedures. So you have to describe the procedures to apply for patenting. Then I would like you to also describe the difficulties you face in applying. So those information you cannot get from my IPO, rather you have to search for in Google or some other sources, okay? The difficulties faced. And then the benefits that you get by getting the IPO, okay, the IP, okay? And finally, you have to make a conclusion. So that one I have explained already, okay? And when it comes to assignment number 2, I have described that you in the instruction that you have to use all those methods being taught in the class to measure or evaluate performance of new ventures. So except the comparative analysis with the industry, that one I don't want you to do it because you may not get the industrial data. Would be difficult for you to collect at this moment. Shorter time assignment also. If it's a good project, I would want you, but since it's an individual assignment, I do not want you to do that, okay? Is that clear, Danish?
Yes, sir. Do we need to include reference if you have or not?
Definitely. If you are using any sources, you have to the references in, right? This is common. This is an academic world. You have to be professional. Even the data sources you are collecting for annual report, you have to put in the at the end in the appendix, where did you collect in the references list? Where did you collect the data? Where did you obtain the annual report? You have to put their source.
Okay, sir. Thank you, sir.
Welcome.
So which means for the intellectual property, any relevant information and sources we can put inside the assignment.
Yes. You have 4 kinds, so you choose any one. You don't have to do on every one, right? I said just choose one.
Okay. So the most important part is we have to describe how to apply the documented in
Yes.
my
The procedures that you have to go through to apply and get your patenting or copyright, and the difficulties that you face and the benefits that you get. You know, that's not that difficult to get, right?
Okay. But sir, like for some of the intellectual property like copyright and trade secret, actually it don't have any documented to like save this as a reference that this is your work. For copyright, they actually
Well, if you
the
understood, if you go to my IPO, I'm not sure Hong Kasun, whether you have visited my IPO, all informations are there. So if you have, if you find that information you get from my IPO are not sufficient for you, in that case, you have to surf into Google and get some other sources. Okay.
okay.
Yeah. The attendance link is in the e-learning, Nur Fariza. There's no way you can't find it. It is there in the e-learning. It is there. Please go to e-learning. It is there. In the WhatsApp group, I have shared the attendance link last week. It's the same link. You can use the last week. Just go to last week WhatsApp group and you will see there. Link is there. You can use that. It's just the word of the day. That's what you have to mention. Huh? And this week, the word of the day is cost of capital. Okay, any other question? Okay, so no question. Then Selamat Hari Raya and Eid Mubarak, and have a very good Eid celebration. And those of you who are not celebrating, wish you have good race and holidays. Okay, so see you after Raya. All right. So can I put up the class now?
And sir, thank you so much.
Thank you, sir. Happy Eid Mubarak.
Thank you, sir.
Happy Eid Mubarak.
So see you after.
Selamat Hari Raya.
Selamat Hari Raya.